Another issue with high frequency trading that can be solved through regulation is direct market access. So basically, firms and the markets have to directly report financial information to investors. And that information is very important because different stakeholders use that information in order to make trades through the efficient market hypothesis, which states that all available information is used when making an investment decision. And that affects stock's price, and it can be dramatic or short, depending on what the company is, how much information is released, so forth and so on. So a stock can go, let's say a company reports bad news, so it can start here, and then in a matter of seconds it can drop pretty fast. So the way that high frequency trading firms take advantage of this is that they start with a company like Apple. Apple's a pretty big company, has billions of dollars, pays a lot of attention to. So they have to release their report right at 9 o'clock. 9 o'clock, 00000, to infinity plus microseconds. So what they do is at 9:00:00, they send that information to the market. But at the same time, through a direct feed and a direct feed to the market, a high frequency trading firm gets the same information at the same time. So Apple releases its information in a few microseconds. It gets a high frequency trading. High frequency trading then takes 50 milliseconds and releases that information through a direct feed right to the market, which affects stocks before the market or other firms have time to react. So the high frequency trading firm can really make trades and do a lot of influence in a very short time. So in, I would say, under a second, the high frequency trading firm is able to change the stock price. However, let's say you at the bottom, or a firm, has to go to the market. That market takes, I would say, double the time to get to a firm, and through people and everything, it could take up to a minute, if not. It could take anywhere from a second to a minute, or even I would say 20 minutes for a firm to react on this. And for us, it also goes to the media and then to you. So it could take it would take you the longest time in order to react as a retail investor. And if you're in there for the short term, you're in a bunch of trouble. That's why most retail investors are long-term investors. However, it has to go first to the market, then to a firm or media who reacts on it, and then to you. And even the firm or you who actually has a stake in the market is affected. So the high frequency trading firm benefits from having direct high-speed access to financial information, and that it can act on rapidly before others do. So even though it is technically fair, it's very inequitable later on.